crypto's one of the things that I've been interested in and actively involved in for almost a decade now. And it's a very complicated space, and it requires a lot of understanding, not only of the crypto markets, but how it fits into the broader macro landscape. Two of my entire favorite people in the space, also like me, come from a macro background and have applied that learning into this new world. And I think this learning, these guys are about the best people to take you through that journey of knowledge as well. So you guys can get up to speed in how you should approach these markets, because there's massive opportunity, but there's also a lot of risks and a lot of pitfalls. It's a kind of a unique marketplace. And these guys, like myself, have learnt the hard way. So Ovi, Mando, fantastic to see you.
Thanks for having us. We're glad to be here. We have a bit of a boy band setup, so we might have to go back and forth a little bit.
Well, it looks very romantic. It's good. You guys have kindly put together an amazing course to help people. And we were talking off camera beforehand about, we kind of all feel like it's a duty that we have to do is give back. We've got a lot out of this space and we want to help people in their journey through it. And you kindly agreed to help people go through that whole journey of how macro and crypto come together, how to trade the large caps, how to trade the smaller stuff, the meme coins, how to think about NFTs. And I think it's an incredibly valuable learning for people to get your experience and your take from applying that kind of traditional investing framework into this wild west of crypto. So before we start, I think let's get your backgrounds and why you guys are uniquely positioned to help people here. So Ovi, do you want to go first and give us your background, give us your story and how the hell you got into this in the first place?
Yeah, that's a good question. So I started out as a trader at Barclays Capital. I traded high yield and distressed credit and credit derivatives. So it was definitely a highly volatile market. It was something which required a lot of risk taking, a lot of uncertainty, a lot of aggressive price moves, and similar levels of volatility, I think, to what you see in crypto. But I basically did that for about 10 years, and I stumbled into crypto in January 2021, so quite late actually into the game, which is when I first bought Bitcoin. It was basically just an inflation trade and central banks not budging in terms of raising interest rates. And from there, I fell into the wormhole on NFTs, and a year later, I was suddenly doing this stuff full time. So it's how I found my way into this world.
And did you find that the high yield market also has a lot of gap risk, kind of discontinuous volatility, asynchronous information where different people have different information sets? Did you find that was actually pretty similar, that helped you understand this market quicker than many?
Yeah, it was very, very similar. I think, the high yield market is an OTC market, so you can only buy or sell if there's a buyer or a seller on the other side, right? So it's not like an exchange. And, there's a lot of asymmetry of information. So for someone who's done their research and understands the credit or the company very well, it's going to give you an advantage. So, as a result, the nature of price moves were very, very gappy. One day something might be at par for a bond, and the next day it's suddenly trading at 70 or 50 or 40. And you could have very aggressive price moves in either direction. So I think being used to how that market trades in terms of it being OTC and understanding that you need to have buyers and sellers, etc., to line up was definitely a big plus. But also being able to weather any price volatility and understand that you are going to take some punches along the way, I think is a big step to have achieved psychologically.
And how did you deal in that market with the fact that players that you were dealing against or trading against had unique information? It's not kind of like you're trading Tesla shares. Often in a high yield market, you'll find that people have different information. And that reminds me of crypto as well. It's like, it's not the same as generalized market. It's more like an OTC market.
Yeah, they do. It's part of the parcel, but in a high yield market, you're not privy to that information, but if this big client comes in and suddenly wants to sell 100 million bonds or buy this much CDS on something, then you have that information and you're privy to it, and you can kind of second guess. The good thing about the crypto space is everything is public, right? Everything is on chain, and you know the bigger wallets, you have a lot of capital, you start to become familiar with the bigger players. So you have another edge in that, yes, like some people may have more information than you to begin with when they can make their first move, but you have all the information of the moves they're making. And so it's up to you sometimes to put pieces of the puzzle together and judge where things could be. But yeah, like, it's very similar. Like, people may have informational advantages and they can make the first move, but it doesn't mean there's not more of a move to be captured. I think if you're sharp and on the button.
Mando,
I would just add to that. Like, I think one thing I picked up on very early in crypto is a lot of this stuff goes to zero. And that's another reason why it's similar to the high yield market, is that gap risk down can be very, very high for a lot of different things. So you can buy into narratives, you can buy into the wrong things. We used to always trade like very clean books. Like, we used to have big positions in a few things, and that's kind of how we came into crypto with as well, and that really helped us. So like, yes, you're dealing with a market which is asymmetric in many different ways, but there's massive opportunity, and often massive opportunity just providing liquidity in some of these things as well. So that really, really helped us. Like, I think having that sort of mindset of not buying into every narrative that gets put in front of you, and just being big at the right times, I think is something that you learn about in crypto as being incredibly useful.
And give us your background as well, because obviously you guys work together, but give me your background so we have an understanding.
So my background is Ovi was actually basically my boss when I joined. He was the
I'm
senior on the desk.
I'm so sorry.
I know. So I came in. Ovi gave me a tough time for the first couple of years, and then we just became very, very good friends. He moved over to the US, and I was in Europe, and we would just chat all day about US and European high yield and distressed debt markets all day. And then I had been getting into investing in wine, in real life art, some other collectibles around 2020, because I was like, inflation's going to go crazy. So I was like, well, I should buy some some inflation hedged sort of assets. Started getting involved quite big around then, and it's a fun market to trade. It's very similar. Again, it's a liquid, it's OTC. You're a price maker to a large extent on a lot of this stuff. Like, you give a price and they may hit you. And then found out about crypto art, and that just felt like inflation squared to me. So I got into that world, and then kind of told Ovi about it, and he kind of dived in as well. So it was similar. It's just I think I had a bit more of a background in getting involved in, let's say, alternative assets before, and that maybe helped with some of like the risk management and also just like knowing of the market. But it was weird having come into that market, because a lot of traders get caught being traders for a long time because they don't really know where to jump to. They kind of learn these sort of button pressing skills that make you only really valuable for trading, and then they get to their mid-30s and they think, how can I jump? Like, I don't really know what to do, and they end up just kind of staying, and it's one more year. And then we found this industry where just all of our skills just seemed incredibly valuable, and that kind of felt new to us. The idea of trading these illiquid assets, particularly crypto, which I think is a bit more, challenging mentally, and all of that sort of stuff we're used to. The wild swings, we were involved in high yield distress, so that suited us. So it just felt like such a perfect fit for us that we both kind of jumped at it, knowing that it would be a really good thing to then build and be entrepreneurs in, and also be traders in.
I think the other skill set, I don't know if you guys traded options much, but options is it's a very similar mindset, because you've got the ability to go to zero, but you get the asymmetric risk reward. It feels that the more people understand options, the more they understand how to size bets in this space, how to think about things, not getting tied to a narrative, accepting that some stuff goes to zero, and that's all okay.
I wish people used options more. Like, I feel like half of the people in crypto should be using options even in crypto, and they don't. Like, it's really a spot buying market, and then people often become bag holders. They hold on to these narratives for way too long, and they forget the reason why they originally got into a trade. So I feel as though a lot of this should be like options, and I feel like the option market could easily develop over the coming years because of it, because it just seems so obvious to me that if you could add that layer to a lot of these trades, then people would be better risk takers.
Now we're going to cover, I'm sure you cover a lot of this stuff in the overall course, but one of the things that I want to talk about, because again, you guys have a good understanding from the past, is position sizing. Ovi, how do you think about position sizing overall? Because, it is volatile, but concentrated bets make all the money as well. So it's people really get screwed up by this thing. How do you think about position sizing?
I think first and foremost, you have to be comfortable with this is an amount of money I'm willing to put into whatever it is, and I'm willing to lose it and write it all to zero. And if you're not comfortable with that, but it shouldn't, especially within crypto, and if you're looking at NFTs and meme coins, etc.
But people aren't used to doing that with traditional equity investments or
I know
ETFs, right? They just don't have that mindset.
They definitely don't. Especially, investing in US equities, for example, it's like, I might lose some money, but it's not going to go to zero. I think with crypto, you have to have the it might go to zero mentality. And so with regard to position sizing, it should never be an amount where if it does go to zero, it affects you, financially in a way that we have to make changes to your life. It should never be that amount. So I think that's the first thing in terms of how much money you have in. But then, you have to think about the returns on this stuff. And if you look at altcoins, for example, the return profiles on these things can be 5, 10, 20x. It can also be down 80 or 90%. So you have to be very cautious on position sizing. It's not, like take down the risk you're taking in the space and maybe playing more things to get a feel for it. But you really have to be pick and choose your spots, And I think where people trip up is they spread themselves too thin and put a little bit in everything and move their money around and try and chase the next big thing. And, then you start getting yourself into a world of trouble, I think. And I think the best thing to do really is like, I'm willing to put in X into crypto, and let's say 60% of X or 70% of X is going to be within the majors, whether it's Bitcoin, ETH, arguably Solana as well. I think should be up there. And then maybe the other 30% you play around with some of the other stuff that could be higher returns, but obviously a lot more risky. And I think that's like the right portfolio split. And I think that should, as a result, back out the right position sizes for you as well.
And Manda, how do you think about the psychology of this? Is, again, you need a different psychological makeup when you're dealing with this, because you have to deal with volatility. And the issue is, as Ovi mentioned, people get really drawn into FOMO. They look at their book. You talked something really interesting that I've really learned, which is actually if you've got a concentrated book and you look at it, you actually feel more in control of your P&L. But what we tend to do is like we end up trying to be VCs, and then we don't really know, and then we don't look at your book, and then half that shit. We've all got the shrapnel of shame in our wallets of the stuff that we bought, but it wasn't big enough to care about, and then it went down 90%. We never looked at it again. We just kind of hide from it. There's a lot to unpack in that. But how do you think about the behavior of how to approach this space properly?
That's exactly it. I feel as though you need to be very brutal. What you asked Obi, I think it was an interesting question there. Like, how do you look at stuff? Yeah, you always have to understand the risk profile of crypto. It's very, very high. But there are more vanilla style investments. Like you can get involved in ETH, Bitcoin, and Solana. Those are probably going to outperform the vast majority of things over the medium to long term than everything else. So that should just be your base level risk if you're going to be involved in crypto. Don't feel like you need to have like a altcoin if you don't think of it. If you don't see a really good, compelling argument for it. And that's what I would say. Like, there is a very imperfect market. And sometimes some of the markets are liquid, so you can get involved at good levels. And sometimes you've got asymmetric information. So I'd be very, very patient, and then just go relatively big when you feel as though there's a real asymmetric bet out there. Because they will come along maybe 2-3 times a year. There'll be a really good asymmetric bet out there. And that will be a really good time to like supercharge your performance or have like a knock it out the park trade. But it's very, very easy in crypto to, go on to crypto Twitter or read some narrative and constantly feel like you need to catch the next thing. And actually, most of the time, ETH, Bitcoin, and Solana, it's going to outperform most of those things, like the vast majority. So just stick to the majors be very patient. And then once you really feel like it's an asymmetric bet, then I do think you can go big, but you don't need to go big into like 20, 30 a year. It should be like, right, this is going to be my bet for the next 3 months. But, maybe even still the majority of my portfolio is in those majors. Yeah,
I mean, I've become even more brutalistic now, which is like, I'm just going to take 1 or 2 bets because, the FOMO ones always fail. And if I don't really know what I'm doing, there's no point doing it. You know, you and I swap messages from time to time about stuff. And I'm like, yeah, it could be a good idea, but really I'm out of my zone of knowledge, right? So I'm like, I just won't touch it anymore. Well, in the past, I will have done it. I'm like, I think I've got my plan. I'm just going to stick to my plan. And I found that it's much easier. And my time horizon, I just extended it and said, look, you know, never was a great shorter term trader. So why fucking bother? You know, when the direction overall is much easier call.
It's so easy to get caught up in narratives. Like, that's one thing you realize in crypto. It's just the FOMO is just insane. So if you can have a lot of discipline about not catching that and really just having what most people would call a vanilla portfolio, you're probably going to outperform most people.
And it gets even harder when we get to NFT space, right? Because then it really becomes incredibly asymmetric. You've got no real basis. It's all a bit more ephemeral. What sticks and what doesn't, what holds value and what doesn't, what catches narrative and what doesn't. That becomes really complex. Ovi, how do you think about NFTs? Because this is right. All I think of NFTs is illiquid assets further out the risk curve. And it's finding the highest quality assets. I mean, it's very much like traditional markets. We'll come on to that in a sec. But how the hell do you deal with NFTs? It's kind of easy. We can all sit here and go, oh yeah, buy ETH, Solana, Bitcoin. When you go to NFTs, it's like, okay, how do I know what's going to survive the next cycle? And the ones that I want to survive are really, really fucking expensive, and I can't buy a fractionalized version of it. You know, everyone goes, yeah, well, fine, just, you know, buy a bunch of Fidenzas. Look, yeah, sure. Most people can't. So how do they think that when you're deep in the risk curve now?
You know, NFTs are such an incredible product and asset class, if you like, because it's a hybrid of like a financial instrument that has speculative aspects that will move up and down in price, of art and culture, like that you would see in the traditional art world, and this new idea of like online communities and momentum and vibes, as many people would like to call it. So it's really all those different things kind of packaged up into this one product, and different things will affect it at different times. So it's very hard, you know, you can't, you know, for NFTs, you can't just create a simple model and say, oh, if, you know, this happens to interest rates, this will happen to NFTs, or if this happens to stocks, this will happen to NFTs. And I think you have to take each project on a case-by-case basis and understand the real drivers and values. And, you know, that's something we're going to touch upon on this educational series and go into a lot of depth, which I think is super interesting, because it's somewhere where anyone can come in and have some expertise, because there's no books on it, there's no history on it, there's no theory on it, there's no university courses or lectures on it, there's no hedge funds who've mastered this or banks who've mastered this. It's really any person's game to come in and be able to do well, because you just have to have a grasp of the things that are important. And that can vary from, you know, the cultural and artistic value of a project. It can be maybe the potential utility and, you know, financial yield you could get from it. It could be the lack of those things and just an NFT that is popular for the sake of like a meme. It could be as basic as that, you know. So there are all these different buckets you can look at within the NFT world, which I think are very, very interesting. And that's why it makes it such an interesting product. And, you know, I know NFTs have had a tough run this year, but they're definitely not going anywhere. They're definitely not going away. And it's an asset class that I think is going to only increase in terms of the interest that grows in it. And I think it's a very exciting space to be in still.
Now, one thing I'm passionate about in this space is that a lot of people have come into it with no prior investing experience or understanding this new term that they're all learning, which is macro. But it actually fits in perfectly to the macro landscape. It has its own risk curve. It has its own yield curve. It has, you know, a multi-currency system, different types of assets, different features. It's very macro. How do you guys think about the importance of macro as a framework to understand how to invest in this space?
You have to have not only a basic understanding, but I would say an intermediate understanding of macro, because we are trading risk assets, right? Risk assets, by definition, they all have correlation to different types of risk and other assets. And crypto is an asset class, NFTs are an asset class, and they all have correlations to other things. So, you know, if you don't understand what's going on in macro, and what I would say is crypto is often very lagged to what's going on in macro, and NFTs are often very lagged to what's going on in crypto. If you don't understand what's going on in the overall macro picture, it's going to make it very tough for you to make the right decisions on managing your crypto risk or your NFT risk. So it is paramount. And that doesn't mean like, oh, today payrolls comes out and this means that my Bored Apes are going to go down 10%. That's not what it means. But in terms of your holistic approach to managing your portfolio and understanding what you should be buying, when you should be buying it, and whether you're buying it at the right price, to be honest with you, you need to have the overall picture. And so without a macro understanding, you are lacking a big chunk of what will eventually drive that as an asset class.
I also think, Mando, that the basic skills of investing, for example, we built the Real Vision Academy around, I did that show with the BBC $1 Million Traders, and we taught ordinary people. There was a few of us from Goldman who got together and trained ordinary people to become hedge fund managers. It was over 2008 in the quiet period over that summer before it all blew up. And the Real Vision Academy is basically that redone, that Lex Van Dam course. And I think the basic principles of investing, the stuff that you guys learned when running books at Barclays, is the same for this space. And that the more you learn the macro plus the principles of investing, the higher probability you will have of succeeding. How do you think that through? And how should people think about it?
Yeah, I think that the issue that some people have when they come into crypto is they see the risk return profile and they think it's like the lottery, right? They'll just do it like the slots, and it doesn't really matter if you lose money. But actually, there's a lot of discipline. If you can create the right risk framework and create discipline about position sizing, like doing a journal of the thesis of why you've gone into a trade, and if that changes, like should you really still be in that trade, how to manage your downside, like all this sort of stuff is incredibly important, because then you really won't blow yourself up. And one thing I've also realized about crypto is that's half the game. Like half the game is there is a massive attrition of traders and narratives all the time. And if you can just survive and catch maybe the right one, just even one or two, you can literally make your life if you catch one of these right. So half the game is surviving, and that requires discipline about like we've already said, there's like risk frameworks, risk sizing, downside protection, and the macro side of stuff is if you can be a good macro trader, it's kind of weird. Crypto is an amalgamation between this weird narrative that we need to move away from a fiat money system, and gold is the future, digital gold is the future essentially, and debt is going out of control, and then it's a mixture of like bleeding edge tech, NASDAQ stocks, like all the utility of this is going to be used in things like AI or management of systems, very complex financial systems. So it's got those two aspects to it. So you really, I mean, it sounds very, very complicated, but it is. The drivers of this sort of stuff is incredibly complicated. You have to understand it all.
The other pitfall is somebody comes into the space, they're starting to get interested because they see things moving, they want to make money, which is fine. But then what they end up doing is listening to the wrong people. How do you filter information in this space? There's kind of an information overload, and there's a lot of charlatans. There's some amazing people in the space. I think this space has the highest quality concentration of quality people of any discipline in anything I've ever seen before. I never forget when we were all in Paris together, sitting around the table thinking, fuck, this is incredible, right? The kind of people who are in this space with this joint mission and purpose. But how do people navigate this? They're a newbie, they come, they want to figure out what's going on, where to invest. How do they do that? Because Twitter can be a whole cesspool and YouTube can be even worse.
Yeah, like you said, it's a very strange group, because you have a lot of people with a lot of foresight, I think, and a lot of futurists, a lot of people with very, very interesting ideas about how the world is going to develop, how finance will develop. You have creatives, you have finance people, you have it is in a really eclectic mix, but you also have huge scams going on, like more than maybe even I knew about before I came into the space. You have to be incredibly careful about who you're trusting. I think that takes a little bit of time. One thing I would say about crypto is if you're going to be a tourist in it and you don't have the time to be in it, it's probably best to be a bit more vanilla, like we've just said about. But if there is a lot of asymmetric information, as we said about. So if you are going to dedicate your time to it, you have to cultivate the people that you're gonna listen to. It does take time to get that list. I'm not going to just name a bunch of people, but for example, like, this whole setup now is like how you can start to navigate people. And there are a few other people who are good guiding voices in the space that I found to be trustworthy. But it does take a little bit of time to do that. So if you're going to do it full time, you need to build up that list, really.
And let's talk a bit about the other side of this, the other risk that people aren't used to, which is bearer assets, right? People already, you find people in stories all the time of people in London having their Rolexes ripped off their wrists and stuff like that, right? That's a bearer asset. They never used to be assets, but they suddenly become financialized. In fact, Rolex prices and NFTs are almost one for one. How do you think about protecting that side? Because it's complicated. This is the other problem with this space is, you get your sister-in-law involved in this and it's like, oh, well, you need to buy this device called a ledger and you have to clunkily put together your things on and but it's kind of also very important. How do you help people with that side? Should they just think about learning the responsibility of self-custody, or are there large enough organizations who can custody safely to make it easier for people?
I think if we're going to get 100 million new people, or I even heard someone, the Coinbase, the guy in charge of Base say 1 billion new people, you can't expect self-custody for everyone. It's just not something that people are used to or feel safe with. I think part of the issue about crypto so far is that some of the main onboarding channels have been these exchanges, and feels like exchanges have a 50% survival rate. Like, there's always dodgy activity going on, and that's been a really, really bad situation because people have assumed they're like banks or they're like shadow banks, and they're not. A lot of them have had horrific risk practices and done horrific things for people's funds. I think you are starting to see a better breed, if I'm honest, particularly out some of the US regulated exchanges. Arguably even FTX US was better regulated, but it was their outside arm that did worse. But Coinbase, I would say would lead that sort of stuff. It would be nice to be like, right, we trust Coinbase like we trust the Federal Reserve, but we don't. We have to accept there is some credit risk to all of these things. Other than that, like if you do want to go down the route of self-custody, which is what most crypto, I would say OGs do, there are ways to do it. It just does require a little bit more of, safety practices. Like there are some hardware wallets you can do. You can do multi-sig wallets. We use multi-sig wallets a lot, which is kind of like, it's difficult for things to go wrong there because you need 3, 5, 7 different people to signers for it to go wrong, and that kind of adds a layer of security to things. But it's something that crypto really does have problems with, and we just hope that with time that onboarding experience, that safety experience for people improves.
So Ovi, one of the things I think about, and I've learned this lesson the hard way, and I'm sure you have in the past, is understand what risk you're taking. And I see people like, oh, well, I've bought this token and I love it and it's great, and I then stake it with some random decentralized or centralized. They have no idea the fragility, and they're getting a 5% yield, and they think they look like a hero now because they're earning what's known as passive income, which seems to obsess people, and then they lose fucking everything, and they didn't realize the risk they were running. I'm a real purist, having learned this the hard way, is like, I don't stake anything. I won't do anything unless I know that that's the risk I want to take, and I'm prepared to lose it all by doing it. How should people think about segregating out their risk? Because it's the same with the exchange you use, the storage of your NFTs. I self-custody everything for the same reason. I just have one risk, price risk. I can sleep with price risk, but I can't sleep with, complete loss risk overnight. How should people think about those kind of risks in this space?
Yeah, I would say my biggest advice there is to not put all your eggs in one basket. So we spoke about concentration, but that doesn't mean, okay, let me have all my ETH and stake it all of it on a random DeFi protocol, all of it on one device, And that's like everything I have in crypto, because you then just have one single point of failure. And if that fails, or something like that fails, you've suddenly lost everything. So,
which is to Mando's point, is don't get taken out of the game.
Don't get taken out of the game. Yeah, it's about surviving. And bear markets in crypto are brutal, but if you can survive them, then there's there's a big pot of gold at the end of that rainbow once you finally get there. So it's very important to make sure you're always in the game. And if you get hacked, or if your ledger device gets compromised, like that shouldn't be the entirety of your assets. And you should, I definitely would highly advocate practicing having a vault, a hard wallet where you're not signing any transactions. It just holds your crypto, your NFTs, or whatever it is, and having a hot wallet which you may use to sign different transactions, etc., and do your day-to-day business with, and maybe even have multiple hot wallets. So you're spreading the execution operational risk across different places. But you should definitely be using strategies like that, such that if something bad happens to you one day, and it probably will, I've seen the smartest people in this space, click on a phishing link and have their wallets drained. If that does happen to you one day, that you're only getting one wallet drain, which doesn't have your most prized assets in it. And I think that's the most important thing. You want to just split up your operational risk and diversify that as much as you can.
So I find the best thing about learning is not from when you get it right, it's when you get it wrong, right? I actually find that people who've made a really good trade, a career-defining trade, often get fixated on that. And we've got lots of hedge fund friends that we all know or know of that have done that, and they define themselves on one trade and they never get back. It's interesting, but it's the mistakes that are the good ones. That's where you learn from. You actually don't learn from your victories as well. What's the biggest mistake you've made that you learned from in this space?
And the biggest mistakes, the biggest mistakes I've made in this space have probably been selling things too early, where I kind of had conviction and where I knew, deep down they were going higher, but because I was practicing a disciplined, profit-taking approach and, just taking all the money off the table in one go. And what I would advise is, and something that I've been very good at, is dollar cost averaging things on the way down and lowering your average cost of whatever asset you're accumulating. And I think where I've messed up is selling that entire lot too early when it goes up 100%, 200%, 300%, and then you watch things go up 1,000%, 2,000%, and you realize you leave so much on the table. So my biggest takeaway from that is be very disciplined about how you deploy risk, but also be very disciplined about how you exit your risk. And you don't have to sell everything in one go. Once it gets to a certain price, you can sell half of what you have, you can sell a third of what you have. And I would highly advise, at some point you'll hit a winner. You'll hit a winner that keeps going up every day, and you're thinking, I should be sensible here and take money off the table, and that's what I did. But always leave a little bit left on the table. And even if that little bit goes to zero, fine, whatever. But you just want to have that option value that we're talking about at the beginning. You want to keep running those options in the space, because $1,000 can turn into $100,000 very easily in the space. We've seen it happen a few times, and I've seen it happen in things that I've sold much too early, and those were definitely my biggest mistakes. So
I think it was
next cycle, peace out.
Yeah, Paul Tudor Jones was always talks about this, is like, and a lot of the old school kind of floor traders would talk about the same thing, which was like, you'd have to run your winners. And it's a really hard thing to do, because you're fighting your own, I've made a lot of money, I need to do the right thing. And what you're doing is you're actually end up buying call spreads as opposed to calls, because you keep capping yourself. But you'll also overextend at the peak. So, and then you'll screw it up. So it's a really hard thing. But I think, as you say, there's ways of mitigating your own psychology, which is, if you're onto a massive bull run, you've made a ton of money, either take your original bet off the table and run the rest, or take 50% off or whatever it is, and then you can run it with more comfort. So, yeah, I think it's a weird thing. I mean, I sold out of Bitcoin I bought it at 200, sold it at 2,000 something, thought I was a hero, it was a 10x. It went up to 20,000 6 months later. I mean, it's like, really? Again, if I'd just done the same thing, it's just, I'd just taken half off.
He's got worse stories than that, I'm telling you. The issue about our position in crypto is that we do it every day, so we can kind of be early to some of this stuff. Like the sort of stuff that if you're not paying attention, you hear 2 months too late and you're like, oh, we actually hear it on the first day that it often breaks. And then you can kind of get caught up in, I don't know, you forget that it's going to take 2 months for it to go mainstream. So you're out of it in 2 weeks. And then in 2 months, you're like, oh my God, what did I do? So that's the sort of stuff that happens.
So what's your biggest mistake or learning?
So Ovi's much better at getting in early to stuff than me. Like, for example, he was far quicker to a bunch of different trades we've shared, we've been in together. My biggest mistake has probably been just not being even more brutal with diversification. Like, I think I at the start in particular, the biggest mistakes I made was just like buying a few too many things and just thinking it was a rising tide lifts all boats sort of environment. And that hurt me a little bit to the start. But I did cut that out relatively early. I haven't really had a spectacular blow up yet. But I think many of the shared things that like Ovi has said, yeah, exactly. Like, but that's the thing. I'm here to survive. I'm here to survive. So I've since that initial realization that it's very easy to buy into narratives. Everyone is trying to FOMO you into everything in crypto because there are no. You realize this when you get out here. That there are some things like ETH, for example, has a burn. You can value it at a multiple of its burn. There are a few other things which have that sort of aspect to it. They have like a discounted cash flow style to them, and you can start to value them. A lot of it is not like that. There are no fundamentals. It is pure speculation. It is based on memetics, or it's largely carried by a narrative. And if that narrative picks up, Bitcoin itself is just a narrative, right? It is just a narrative of value, decentralized value. So largely that extends to the rest of the space. You know, like if we all didn't believe Bitcoin was valuable, it wouldn't be valuable. So that becomes the same framework for a lot of stuff in the space. And you'll see that maybe it doesn't define the whole of the value, but it can define like 70 to 80% of the value sometimes. And you just got to be very, very careful not to buy into those narratives because everyone is trying to push them because they've seen it be successful before. And I think I got caught up in a bit of that at the start.
Yeah, I think my biggest mistake has been the same. And it's not a mistake, it was just a learning of how to navigate the space and seeing the FOMO and thinking, let me just have a broader portfolio. Yes, I was still always very concentrated because I kind of knew what I wanted to do. But that broader stuff just becomes a mental distraction. And then it becomes something you don't look at. And I've done this running portfolios when I was at GLG. My portfolio would get too big and then I would lose money because of these bloody small positions that you don't even look at or think about. And you're like, I would then frequently come in, close the entire book, go home for the day and start afresh.
100%. Those are the positions that you treat like lottery tickets as well. You're like, oh, I don't really watch. And then it goes down 90%. And then you have, like, they all go down 90%. And you're just like, oh, like, why did I even do any of this stuff? Like, it's so much better just to be more levered to the stuff I really believed in rather than doing some of those. So, yeah.
Guys, listen, thank you for this. I think there's so much for people to learn, and bringing all your experience to this and helping people in their journey as they go through this course, I think it's going to be invaluable to people. I think, you know, the more we can do to help other people in this, because it is one of the biggest opportunities anybody could ever be given. But you need to learn the rules of the game. And the rules of the game, as you say, are to stay in the game. And I think as people go through this course and the understandings from you guys, it's going to give them a very good chance of doing that and succeeding on the other side. So thank you for everything you guys do. And I really hope people enjoy the rest of this as well.
Yeah, it's been a pleasure. Yeah, thanks for having us.
We hope you enjoyed the video. At Real Vision, we help you understand the complex world of finance, business, and the global economy with in-depth analysis from real experts. Join the revolution at realvision.com.